President Trump just announced major U.S. combat operations against Iran. U.S. and Israeli airstrikes hit Tehran's central area, Iranian presidential offices, and the Supreme Leader's compound. Iran retaliated with missile strikes on U.S. bases in Bahrain, Qatar, Abu Dhabi, Kuwait, and Saudi Arabia. Iran also struck Israel. Gulf countries shut their airspace. UAE, Qatar, Kuwait, all closed. Officials say strikes may last days or weeks. Israel's stated goal, end the Iranian regime. Iran's response, no red lines anymore. Houthis resumed Red Sea attack threats, and oil shipments through the Strait of Hormuz, where 20% of global oil flows, are now disrupted. Oil companies have paused shipments. But here's what you need to understand. The markets moved before the headlines. Gold, silver, and oil were spiking together hours before Trump made the announcement. Physical gold in Asia was trading at a $282 premium over Western paper prices. Let me walk you through what happened overnight, what the price data is telling you, and why the gap between physical and paper pricing just became the widest it has been in years. Because when war breaks out and supply routes close, the market for real metal and the market for paper promises stop pretending to be the same thing. US plus Israel versus Iran. Retaliation. Across the Gulf, airspace. Shut. Let's start with the facts of what occurred. President Trump announced major U.S. combat operations against Iran. This was not a limited strike. This was not a symbolic show of force. U.S. and Israeli forces conducted coordinated airstrikes targeting Tehran's central area, Iranian presidential offices, and the compound of the Supreme Leader. These are not military targets on the periphery. These are strikes aimed at the heart of the Iranian government. Iran's response was immediate and coordinated. Iranian missiles struck U.S. military bases across the Gulf region, Bahrain, Qatar, Abu Dhabi, in the UAE, Kuwait, and Saudi Arabia. Iran also launched strikes against Israel. This is not a one-sided operation. This is active combat between the United States, Israel, and Iran, with multiple Gulf nations now directly in the line of fire. The immediate consequences: UAE, Qatar, and Kuwait shut their airspace. Commercial flights are being diverted or canceled. Officials from both sides have stated that strikes may continue for days or weeks. Israel publicly stated that the goal is to end the Iranian regime. Not deter, not degrade, end. Iran's official response was even more stark. No red lines anymore. That is not diplomatic posturing. That is a declaration that all restraints are off. Houthis, backed by Iran, have resumed threats of Red Sea attacks, which puts shipping through the Suez Canal at risk. But, more critically for commodity markets, oil shipments through the Strait of Hormuz are now disrupted. Multiple oil companies have paused shipments. The Strait of Hormuz is the single most important choke point for global oil supply. 20% of the world as oil flows through that narrow passage. If it closes or becomes too dangerous to transit, global energy markets face an immediate supply shock. Before headlines, hard assets were already spiking. Now here is what separates informed money from reactive money. The markets moved before the headlines broke. Hours before President Trump's announcement, gold, silver, and oil were rising together. This is not normal commodity correlation. When all three move in unison before a major geopolitical event, it tells you that someone with access to information, whether through intelligence channels, geopolitical analysis, or inside positioning, was already buying hard assets in anticipation of what was about to be announced. Gold was rising, silver was rising, oil was rising. And critically, the move was happening in physical markets and safe haven assets while crypto was selling off. Bitcoin dropped to $63,000 with $100 million in liquidations happening in minutes. That is a risk-off rotation. Money was coming out of speculative digital assets and moving into physical hard assets and safe haven instruments before the general public knew why. This is how institutional money operates. They do not wait for CNN to confirm the story. They position ahead of the news, and by the time retail traders see the headlines and react, the best entry points are already gone. The fact that gold, silver, and oil were moving together, hours before the strikes were announced, tells you that the informed money knew, and they were buying physical exposure, not paper promises. $282 gold premium times from $12 silver premium, you're in physical versus paper. Explodes. Let's look at the actual price data, because this is where the story becomes undeniable. That is a $282 premium over Western paper gold prices. Let that sink in. Asian buyers are paying $282 more per ounce than the price being quoted on Western futures exchanges. That is not an arbitrage opportunity. That is a breakdown in the pricing mechanism. Physical gold in Asia is trading as if it is a completely different asset than paper gold in the West. Now let's look at silver. Hyperliquid Silver, a 24/7 silver trading platform, is showing prices around $95. Western spot silver is at $93. But Shanghai spot silver is trading at $105, and Shanghai silver futures are at $108. That is a $12 premium for spot and a $15 premium for futures over Western paper prices. These are not minor discrepancies. These are structural divergences that tell you the physical market and the paper market are no longer pricing the same thing. Eastern buyers with access to physical supply are telling you, through the prices they are willing to pay, that Western paper prices do not reflect the true cost of securing physical metal in a world where supply routes are closing, airspace is shut, and the Strait of Hormuz is at risk. 162K to 118K contracts charge a 27% drop delivery stress signals. Now let's talk about what is happening on the COMEX, because the futures market data is flashing warning signals that cannot be ignored. COMEX silver open interest just collapsed from 162,000 contracts down to 118,000 contracts. That is a 27% decline in open interest. Normally, when open interest falls, price falls with it because falling open interest typically signals that both longs and shorts are exiting and speculative interest is declining. But that is not what is happening. Open interest is falling while price is rising. That is a signal of delivery stress. It means that shorts are being forced to cover not because they want to exit their positions, but because they cannot deliver the metal. When open interest falls and price rises simultaneously, it suggests that the paper market is losing participants because confidence in the ability to settle contracts with physical delivery is eroding. At the same time, COMEX registered silver, the metal available for delivery, just increased by 2.3 million ounces. But eligible silver, metal stored in COMEX vaults but not designated for delivery, declined by 2.6 million ounces. So total silver in the COMEX system is around 360 million ounces, but the shift from eligible to registered suggests that metal is being moved into deliverable status, which typically happens when delivery demand is building, or when the exchange is trying to ensure it has enough registered inventory to meet potential delivery requests. Lease rates are also rising, currently at 1.6%. When lease rates rise, it signals that physical metal is becoming harder to borrow, which means that shorts who need to deliver are finding it more expensive to secure the metal they need. The swap is also negative, and the front month is trading stronger than later months. All of these are classic signals of delivery stress and physical tightness. Thailand, dealer halted. Chinese recyclers. Bidding high, gyred central banks. Buying the physical market is telling an even more dramatic story. Reports are emerging that a major precious metals dealer in Thailand has halted trading entirely. When dealers halt trading, it is because they either cannot secure supply at quoted prices, or they believe prices are about to move violently and they do not want to be caught on the wrong side of the trade. Chinese recyclers, the entities that process scrap silver and return it to the market, are bidding aggressively for silver at high prices. This is significant because recyclers typically operate on tight margins and are price-sensitive buyers. When they are willing to pay elevated prices, it signals that they believe they can turn around and sell that metal at even higher prices because downstream industrial demand is strong. Central banks continue to buy gold. ETF holdings are rising, not falling, which means that institutional and retail investors are not selling into this volatility. They are buying. Industrial demand for silver remains strong because solar panel production, electric vehicle manufacturing, 5G infrastructure, and defense technology all require silver, and none of those demand sources can be easily substituted or delayed. Mine supply remains tight. There are no massive new silver discoveries coming online. Existing mines are being depleted, and the lead time to bring a new mine from discovery to production is measured in decades, not years. Supply cannot respond quickly even if prices rise significantly, which means that when demand surges, as it does during geopolitical crises, the market has no supply buffer to absorb the shock. Why this time is different. Here is the core thesis that explains why this moment is different from previous geopolitical flare-ups. We are not just dealing with a war. We are dealing with war plus a structural supply deficit, plus industrial demand that cannot be delayed, plus a monetary system under stress, plus a physical market that is refusing to accept paper pricing. Silver has been in a structural deficit for 6 consecutive years. That means global demand has exceeded supply every year since 2018. Industrial demand continues to grow as the energy transition accelerates. At the same time, the monetary system is under extraordinary stress. U.S. debt is projected to hit $64 trillion by 2036. Central banks are rotating out of treasuries and into gold at a pace not seen since the 1990s. The dollar's share of global reserves has fallen to a 32-year low. Now add geopolitical instability, strikes on Iran, the Strait of Hormuz at risk, Gulf airspace shut. Oil supply disrupted. Mexico, the world's largest silver producer, experiencing security challenges. and Eastern buyers paying $280 premiums for gold and 12 premiums for silver, because they understand that in a world where supply routes close and currencies debase, the only thing that matters is whether you actually have the metal. This is not just another geopolitical headline that markets will shrug off in 48 hours. This is a convergence of structural supply tightness, monetary instability, an active military conflict that directly threatens the supply routes and energy infrastructure that the global economy depends on. And the physical market is pricing that reality while the paper market is still pretending everything is fine. The signals that will tell you what happens next. So what do you watch right now to understand whether this escalates further or whether cooler heads prevail and markets stabilize? First, strike duration. Officials said strikes may last days or weeks. If strikes continue beyond 48 hours, markets will begin pricing in a sustained conflict rather than a one-time operation. Sustained conflict means sustained supply disruption risk. Second, Iran escalation. Iran said no red lines anymore. If Iran strikes additional US or Israeli targets, or if Iran threatens to close the Strait of Hormuz entirely, oil prices will spike and a safe haven demand for gold and silver will intensify. Third, Hormuz closure. Watch for confirmation of whether the Strait of Hormuz is open, partially disrupted, or closed. If it closes, we are looking at a genuine global energy supply shock. Fourth, Asia versus West premium. If the $280 gold premium and $12 silver premium persist or widen, it confirms that physical buyers believe Western paper prices are disconnected from reality. If premiums compress, it suggests the panic bid is subsiding. Fifth, COMEX inventory and open interest. Watch whether registered silver continues to rise and whether open interest continues to fall. Falling open interest with rising prices signals delivery stress. Sixth, lease rates. If lease rates continue rising above 1.6%, it confirms that physical metal is becoming harder to source and that shorts are struggling to deliver. Seventh, futures gap open. When Western futures markets open, watch whether they gap higher to reflect overnight Asian premiums or whether paper sellers try to slam prices lower to defend key technical levels. The market that matters is the one that can deliver metal. Here is what we know. US and Israeli forces struck Iran. Iran retaliated across the Gulf. Airspace is shut. The Strait of Hormuz is disrupted. Officials say strikes may last days or weeks. Israel's stated goal is to end the Iranian regime. Iran says no red lines remain, and Houthis are threatening Red Sea shipping. This is not a contained regional conflict. This is a multi-front escalation with direct implications for global energy and commodity supply. But the markets knew before you did. Gold, silver, and oil were rising together hours before the headlines broke. Physical gold in Asia is trading at a $280 premium over Western paper. Shanghai silver is at $105, while Western spot sits at $93. PAXG spiked to $600 while Western futures lagged. Bitcoin sold off with $100 million in liquidations. And COMEX silver open interest collapsed 27% while price rose, a classic signal of delivery stress. COMEX registered silver is up 2.3 million ounces, but eligible is down 2.6 million ounces. Lease rates are rising. Swap is negative. Front month is stronger than back months. Central banks are buying. ETFs are seeing inflows. Thai dealers have halted trading. Chinese recyclers are bidding aggressively. And industrial demand remains structurally strong while mine supply remains tight. This is not just a war story. This is not just a supply story. This is a convergence of geopolitical instability, structural supply deficits, monetary system stress, and a physical market that is refusing to accept paper pricing. The gap between what physical metal costs in Asia and what paper contracts trade for in the West has never been wider. And when that gap exists, the question is not whether it will close, it is which price moves to meet the other. Does paper rise to meet physical, or does physical stop accepting paper prices entirely and force a reset? Watch the next 48 hours. Watch whether strikes continue, watch whether Hormuz stays open, watch whether premiums hold or widen, and understand that in a world at war, the market that matters is not the one that trades the most contracts. It is the one that can actually deliver metal when you need it. Right now, that market is in Asia, and it is paying $282 more per ounce than the West.